Bismillahirrahmanirrahim. Today we are going to discuss the chapter number 9. It's a audit risk. We have studied in last lecture the different stages of an audit, and the first one was the acceptance of an audit. And we see in the acceptance of an audit procedure, there is a point of audit risk over there. So we studied over there if the audit risk is acceptable for you or an auditor, then an auditor says yes for an audit, accept the audit, or maybe reject an audit. Today, we are talking about in detail in this chapter about audit risk. Okay, here we have the introduction of an audit risk. Audit risk is a technical term related to the process of auditing. The first thing to appropriate is the audit risk cannot be reduced to the zero, as an audit cannot provide absolute assurance, only reasonable assurance. This is because an audit has inherent limitations. Okay, firstly, we are studied in our previous lectures about the absolute assurance or reasonable assurance. As the auditor, when doing an audit, he is bounded because of the inherent limitations from the company, inherent limitations from an audit. So because of this, he give an reasonable assurance, not a granted assurance, not a guarantee for an audit. Reasonable insurance with reasonable audit. Okay, look toward the simple definition of an audit risk. Audit risk is auditor wrong opinion, and auditor want to know it. The auditor think the wrong opinion if he created about the financial. So this is the audit risk for him or for her for an audit firm. So wrong opinion is the audit risk. Audit risk. We have to discuss in detail about audit risk. This is the risk that the auditor give an inappropriate opinion on the financial statements. This is about the auditor giving the opinion, and this will be the inappropriate about the financial statement. Like we say, the audit opinion is the financial statement show a true and fair view when in fact they contain a material misstatement. Auditor giving a true and fair view of an audit about the financial of an entity, but in fact the material is misstated over in the financial statements. So this means that this is a not true and fair, and just because of this material misstatement, the auditor risk occurred in the public document, occurred in the public report of an audit. So because of this, auditor having a high risk because he is generating a wrong opinion and writing a wrong report about the financial of an entity. Audit risk is a function of two risks. Okay, categorized into two areas. The first one is the risk that is draft financial statement actually contain a material misstatement. This is the risk of material misstatement named as the ROMM, risk of material misstatement. The first one mean to say that due to the material misstatement there is a risk. Okay. Second one is the risk that the auditor failed to detect it. So the financial statement are published with the misstatement still present. This is the detection risk. In second point, auditor fails fails to find the material misstatement, and because of failing to detect the misstatement, Still, the material misstated present in the public report. So this is called the detection report. The auditor is unable to find. We can look toward the chart of this audit risk. Simply in this chart, audit risk is classified into two forms: the risk of the material misstatement and the detection risk. Risk of material misstatement is further categorized into two forms: inherent risk and control risk. First is the audit risk. Audit risk is the wrong opinion of an auditor because of, you may say that, material misstatement. And audit risk is categorized into two forms: the risk of the material misstatement and the detection risk. Risk of material misstatement is further categorized into two forms: inherent risk and detection risk, control risk. Okay, we will see or we discuss this chart in detail. The first form of an audit risk is the ROMM. ROMM is the risk of material misstatement. ROMM has the two components. You can say two variables consisting on these two components, namely as the IR and the CR. IR stand for inherent risk and CR stand for control risk. Inherent risk is related to the organization. Either the organization having misstatement and these misstatements are high or low. Inherent risk, you may take an example like a complex process in organization, and because of this material statement are created. There is a complex transaction system in the company. Because of this, there is a material misstatement can occur. Because of complex organization structure, just because of these, the material is misstated. So we can say inherent risk. Inherent risk is the company organizational associated risk. You may take an example like a bank in its future or contract options. You have done a contract with the bank about a complex product, financing product. So it may be on your end you are not understand properly and you make a complex transactions because you are not such a knowledge. So you make a complex transaction and a complex transaction system is generated on your end. So because of this, the material is misstated in your financial statements. Another example, you may say that, let's suppose your staff is left from your organization. You are hired a new staff in your organization, and this new staff is inexperienced as you expecting for your company, and they may be cause a material misstatement in the financial. Like maybe you can say that example of the jewelry shop. In the jewelry shop, the items are very limited, but the prices of the items are very high. So cash counting over there, if there is a complex system, so it may be cause a misassertion or misstatement in the financials. Okay, inherent is the organizational associated risk. It's related to the organization. So RAM is categorized into two: inherent risk, first one we discussed. The second is the control risk. The risk that the client own produced, the risk that the client own procedures don't pick up and correct the error. This is the control risk. The risk that the client's own procedures don't pick it, is saying about the internal control. Internal control are not picking up, internal procedure are not picking up that one, that type of a risk, are not correcting. So because this is the error occurred. This is called the control risk. In simple, again, I am defining it. It's a internal control system. It's about the internal control system. It is related to the auditor. Either auditor detect misstatement or not, are unable to detect the material misstatement called the detect risk. Okay, control risk. The risk is related to the internal system of the company, and you may say that because of the management, there is a because of the management control or the control strategy of a company, there is a poor internal control system. You may say that there is internally can't pick the errors. Your system is not picking the errors. Like an example, there are no checks, there are no supervision for the devices. So you may say that this cause a material statement in the financials. So the internal system is weak. Because of this weakness, the material is misstated in the financial statement. Poor control is over there. The centralized line is related to the detect misstatement. So wrongly put it over here. We'll discuss in our detect risk. Okay, assessment of a risk. How an auditor assess the risk. Okay, before I go for an assessment, I want to give you an additional information about the control risk. As I told you, it's related to the internal control system. If you think your company trained the staff, like we take an example of jewelry shop, and you train your staff in a jewelry shop, so your staff can easily understand what one the original product and what one is the not original, so he can easily classify it after getting the training. So there is a strong control system over there, and the control risk is low over there. Or you may say there is a cash business, and every night you put it all of your counted cash into the bank. So I can say this is a strong control system, not a weak system. So control risk will be low over there. And if you don't, and there is a misplacement of cash, maybe mishap with the cash activity, so you can say there is a weak system and there is a control risk over there. Now we have to look, as we have studied the audit risk. Audit risks categorized into two form: ROMM and the detect risk. ROMM, risk of material misstatement, are further categorized with the two form: inherent and the control. Inherent is related to the company, and control is internal system of the company. So because of this, auditor opinion as accordingly change. So we have to look how an auditor assess these risks. Assessment of risk. Auditor firstly collect the information of organization, then he will collect the internal controls information of the internal control system. Now this is the time auditor assess both of risk IR and CR and set the detection strategy for an audit, like what will be the nature, what will be the timings, and what will be the extent for an audit. And after all, he or she or audit team will make an audit opinion about the financial of the company. Now we have to look the risk assessment model or equation. Okay, a very simple model of risk material misstatement. We can see audit risk is equal to inherent risk, credit risk, and the detection risk. Okay, I discussed inherent risk. I discussed the credit risk, control risk. Now I have to discuss the detection risk. Detection is risk is associated with the an auditor. It's a related to auditor. Either auditor can detect misstatement or not. he or she can detect or detecting the misstatement of the material or not. Unable, it may be unable to detect the material misstatement called detection risk. If he is unable, so it will be the called as a detection risk. And because of this, as he is unable to find the misstatement, the statement are attached with the with the audit report to for the public in the open market for the investor as well. And so misassertion, misstatement are still over there. So this cause a risk for a company as well for an auditor. So I think it's a error because of the and at the end of an auditor. So we are looking the model of an audit risk assessment. The question is over there. Audit risk is equal to internal inherent risk multiplied by control risk multiplied by detection risk. Detection risk is further categorized into two forms. Audit risk based on inherent risk, control risk, and detection risk. From slide 1 we studied. Okay, what happened if we see these two kind of equations over here? Firstly, we see that if audit risk is equal to inherent risk and inherent risk is high, similarly the control risk is high. So what happened here? We are seeing that material misstatement from the company, as inherent risk is related to the organization and inherent risk is high. Company complexity process is high, transaction is complexity is high. Issue is on the end of the company and the end of association. Similarly, the control risk, there is a poor internal control system over there, and just because of this, auditor find that everything or most of the things, most of the material is misstated. So his detection risk is low because he is lack of work to do, and there is a lot of wrong material statement over there, so he easily can find. And on his end the detection risk is low. Similarly, the detection risk is low is equal to the audit risk is equal to low. Audit risk of a company, audit risk for an auditor is low. Again, I am describing this equation. Audit risk will be low if the inherent risk is high and the credit and the control risk is high. Because of inherent risk and control risk, both of the risk are the end of the company. So detection risk, auditor having a low task to do for having a low work burden because already he have clear about the problem of inherent and control risk. In other situation, when the inherent risk and control risk are low, company is very efficient about the financial statement. Everything is very easy and very well prepared. Similarly, the control system is very strong in a company. Everything is as according to the procedural. There is a invoices supervision over there, invoices signature over there, invoices proper data is maintained. There is a reconciliation is over there. So here the work of an auditor will go up because he need to find, he need to detect, he need to detect the errors of an company. So the detection risk will be high because if he can't find and he write a report about, and maybe at the end the report having the material statement, so the detection risk will be high. As detection risks are categorized into two forms. The first one is the simple sampling risk, and the second is the non-sampling risk. Sampling risk, it's when an auditor doing an audit for a company, he select a few invoices, or you can say number of invoices, like take an example of 50 out of 10,000 invoices. And luckily, all the invoices are properly approved, signature are over there, signed are over there, data is over there, data is maintained for, everything is supporting is over there. So, and because of this, the remaining 10,000, the remaining invoices in 10,000, apart from the 50, may be having the issues, may be having the material statements. So there is a risk over there. So because of this 50, the 50 are the okay invoices, and the auditor making opinion that the company is going well. But in fact or in actual, apart from the 50, the other remaining invoices from the 10,000 may be having the problem, and maybe there is a misstatements over there, that the auditor opinion will be you can say the auditor detecting the risk wrongly. He is unable to find, so detecting risk is high over there. How we reduce this kind of sampling risk? You have to increase the sample size. If you select the more sample in your choice, you can easily detect the right answer, right? You can easily make a right opinion about the sampling risk. Another example of non-sampling, here auditor with expertise and trainings go a straight and full-fledged proper assignment. No selection, complete work is have to be done over here. Okay, in last we have to look toward the to reduce audit risk. Audit risk according to the ISA 300, 330. To reduce audit risk to an accepted level, determine response at the financial statement level and the assertion level. What is the financial statement level? Here we have a more experienced staff, more supervision, professional skepticism, and the assertion level. The figures, the facts are true, element to element, entry to entry. The assertion, the figures are true and fair. Design and perform audit procedure whose nature, timing, etc. are responsive to the assessed risk of the material misstatement. Okay, giving you the theme of inherent risk and the control risk. Hope you have to understand today lecture. It's all about the audit risk. Audit risk categorized into two form. The first one was the first one is the ROMM, risk of material misstatement. The second is the detection, as the audit is the wrong opinion, and because of this opinion, how this opinions can be created, or how this opinion can be modified or can be generated by an auditor. So we can see, because of there is audit risk categorized into two, ROM and the detection. ROM is related to organization, and the detection is related to the auditor. Either the auditor detect the risk or not detecting the risk. And because of detecting the risk, what happened to the company and what happened to the audit. So that's why we call it the audit risk, detection risk. And second, and the ROM is categorized into two, inherent and the control risk. Inherent is a company associated risk, like you discuss the complex process and complex transaction, and the control is the internal control, poor internal control of a company. After assessment of these both risk, editor make an opinion about the assertion about the statements. Then he will see, or we will see, the equation of an audit assessment, that was audit risk will low when inherent risk and the control risk are high. And because of high inherent risk and because of high control risk, as there is a bad control in the company. The auditor have a limited work to do because already the everything is based on the wrong information or wrong basis. So auditor detection process is, you may say that detection process is not comparably too hurdle or too hard. He can easily detect, so he can save himself from the detection risk. But in the second point, if the internal control of a company is high and misses inherent risk, the company process, company system is very good, true and fair assertion are over there, then the detection risk may be high, because auditor need to keenly find the risk, keenly find the misassertion, and it may be he cannot. So the detection risk, and because of this detection, he is unable to find, because of this he is unable to find the statement, the possessions, these statements are published for the public. So it's having a very bad impact for the company as well for the auditor. So this is detection risk need to be focused for. So in last we discussed the sampling with the taking sample. More the sample size will reduce the sampling risk. A non-sampling technique will be used when all the work is have according to the different stages properly, and there is a financial statement level and assertion level is related to the staff, experienced staff and supervision, while another one is related to the statements or material or assertions or figures and facts. Thank you for today lecture.